I've been asked to talk about political risk and sovereign risk. What's my expertise in that? Well, I've spent a very, very, very great deal of years talking to both direct investors and to debt investors, and I will clarify what I mean in a moment. My final claim to fame or infamy before I left banking was to arrange Kenya's Eurobond, which I know everybody talks about. I am probably one of the few who talks about it positively, for reasons I will give it in a moment. But all these years of talking to investors in the US, in Europe, in South Africa, in Asia, is what I try to distill when I talk to investors, to journalists, to interested Kenyans here. My perspective is really from an 30,000 feet high level. So I won't talk about individual sectors or what's happening. The election is the election, but I'll tell you how an outsider sees us, and hopefully give you a perspective to round off what Kip has told you from a Kenyan business leader's point of view. So, political risk, sovereign risk, and what have you. Let me start by giving you context. I don't think you caught the gist of what Kip said about Kenya's place in Africa and Africa's place in the world. The reality is that the world has a restless need for growth opportunities, for investment opportunities. Africa is that place today. I remember many years back, my office was across the road, and a young man called Ali Khan, the statue, who I'm sure you now know, had just returned to Kenya. And he came to my office, which overlooked Kimathi Street. And he was talking with the despair about the potholes down the road. I turned to him and told him, those potholes represent opportunity. Somebody has to fill them in. Somebody has to build these roads. And that changed his entire perspective, as he's put it in his book. And that is the perspective the world has. The world sees $16 trillion worth of infrastructure investment required. The world sees a young population, it sees education opportunities. It sees opportunities for health. It sees opportunities for digital industries. It sees a lot. We Africans don't see that because we are down here in the continent, not looking at what the world is looking at. That is what the world is looking at. In that context, Kenya is extremely important. Investors offshore tend to look at Africa in sub-Saharan Africa, in three broad suites. West, with Nigeria as the preferred entry point, but given the chaos there, Ghana perhaps the alternative to use as the entry point. South with Johannesburg, and east with Nairobi, Kenya. Kenya also has one other advantage. Again, I urge you to think geopolitically. The most active economic area is the area bounded by the Pacific and Indian Oceans. What does that mean? Economic activity in the world, the gravity has a shift point of gravity has shifted from the Atlantic to the Pacific and the Indian Ocean. So we sit at the western end of a very large economic basin. That means that unless we go absolutely crazy, this is the entry point. And why do they want to come here, the investors? Not just because of our tech, the great as it is, or of our young population, because we are also a location story. We are a location story as the entry point to the riches of Central Africa, DRC, Sudan, Zambia, whatever. We are a reservoir of educated manpower. We are, and I think this statistic still holds, we, Zimbabwe and Nigeria, remain the three largest reservoirs of educated manpower and increasingly of trained manpower in Africa. So from an investor perspective, Kenya is actually quite important. And part of the interest that Kip talked about in our election is because people are looking at in that perspective. Political disruption and mass action. What does that do to an investor? First of all, investors, especially foreign direct investors, have a pretty long-term perspective. Political disruption and mass action occurs in many countries. But unless it is prolonged, they will stay. Now, that's a generality. If you go into individual sectors, of course there will be differences, and Kip pointed out some of the sectors that any investor, local or foreign, will look at with great wariness before jumping into. But by and large, investors tend to look at political action of this nature as a given. But it has an impact. The impact is what investors term political risk premium. What it means is that whereas I would accept 5% return on my investment in the US, maybe 10% in other parts of Asia, I will ask for 25% in Kenya. And that has a direct bearing on both the types of investors who will come here, the type of investments that will come, and the type of impact it will have on us as a country. 25% return, which is what your typical PE firm will ask for on this continent, means that by and large I will invest more in capital intensive industries than in people intensive, because capital intensive industries intrinsically have a higher value. So you wonder why we have growth and no employment. That is one of the reasons that you skew growth towards those sectors that will use capital rather than will use labor. So there is a cost. There's a lot said, and I think is part of the question about rating. Let me explain. Sovereign rating is to do with the ability of a country to pay back its debt. If a country can pay back its debt, and you're a typical investor, you can actually go and get the prospectus for Kenya when we did the Eurobond, and you will see it's on the Treasury website, and you will see the elements that investors take into account when they are deciding how to rate you. And ratings globally range from AAA down to junk. Financial investors are very cold-blooded. It doesn't really matter whether you are slaughtering each other on the streets, as long as you can pay back your debts. It is as simple as that. It sounds heartless. It is heartless. But if you look at the media today, Venezuela has been in chaos for quite some time. They have had hundreds killed on the streets. People are starving. There's an amazing statistics which shows that the bulk of the population has lost weight because of the lack of food. This from the country with the world's largest reserves of oil and gas, but totally mismanaged. It's a bread basket. 4 weeks ago, Goldman Sachs went and bought some debt from Venezuela. It was attacked very badly by the media, NGOs, but that's how investors behave, financial investors. they ask themselves, can they pay? Will they pay? Simple as that. There are no other considerations. You may be bleeding on the streets. That is nothing to do with them. And they look at four elements. Rather, all investors coming into a country like ours will look at four elements when they are assessing investment. But this especially applies to financial investors. It's called NECT: nationalization, expropriation, convertibility, transferability. If I invest in that country, will they nationalize my company? Will they expropriate my company? If I invest by way of financial investment, will they allow me to convert my money from local currency to dollars? And will they allow me to transfer it? And even if I am a direct investor, will I be able to take out my dividends and my profits and what have you? Those are the cold-blooded realities. And that is why on the morning of June the 8th, I think it was, 2014, when the attacks on Mpeketoni took place, which made headlines globally, I was seated at the offices of JP Morgan in London, opening the bidding together with my colleagues from JP Morgan and Barclays Bank, in the company of the Treasury Cabinet Secretary, the PS, Deputy Governor, and various people, opening the bidding for Kenya's Eurobond. And Kenya's Eurobond, we had wanted to raise initially $1.5 billion. We got $8.8 billion. Now, picture this. We are sitting in JP Morgan. The Reuters head office is across the street. There's a tracker going all day. The headline all day in London was Mpeketoni. And yet these very investors are bidding $8.8 billion when all we had hoped for was 1.5, and in the end we took 2. Why did they do that? Because Kenya has a very good track record, not impeccable, but a very good track record of paying back debt. Our constitution, for those who care to know, prioritizes debt service above all else. The first charge on the consolidated account is debt service. The second charge is constitutional officers, and then come everybody else. So from an investor perspective, Kenya is a great risk. From a financial investor perspective, Kenya is a great risk. Of course, they will read the media stories which people put out. Those may impact one or two. There are ethical investors or investors who don't want to invest if a certain NGO or a certain advisor says you can't because of this and that happening. But by and large, political disruption and mass action, unless it affects Kenya's ability to service its debt, which translates to unless it affects companies' ability to pay taxes, because those taxes are the ones which are servicing our debt. So there is no direct impact, but there is an indirect impact if you have a prolonged, remember I said prolonged action, if you have a prolonged disruption, but not immediate. That speaks for debt investors. Although I must caution that the Goldman Sachs story I told you is symptomatic of a developing trend where NGOs, human rights bodies are starting to target financial investors, giving them a bad press, a reputational risk, in order to stop them investing in countries which these activists feel are not worth investing in. And those eventually will have an impact on us. So again, going back to Kip's comment about media freedom and allied activities, if we get a reputation for being repressive, then that will eventually affect our ability to source funding offshore. That That is a given. As for foreign direct investors, they tend to look more at long-term trends. What works? What really saddens me today when I talk to investors coming in here is how much foreign investors are able to put aside all the noise surrounding our politics and actually invest and take a very long-term view and take risks that Kenyans, because we are directly impacted by the headlines and the noise, feel aren't worth taking. I see that a lot in agriculture, where global trading conglomerates like Cargill and Dreyfus are beginning to get heavily involved in our grain industry. We moan about prices of maize and wheat. Cargill is busy consolidating the grain industry, and in 10 years' time, you will wonder. Cargill has done to grain what Brookside did to milk, and your NCPBs look irrelevant. Those are the things happening. And I think if there's one thing, if I may make an aside, we can learn from foreign investors is the ability to think through the fog and the noise and look at what works and what is going to align itself to long-term trends. So your FDI, Kenya hasn't been very successful in attracting FDIs because a lot of the FDI into Africa has been into oil and gas or into mining. But within specific sectors of FDI, of industry and commerce, we are attracting a very quiet, but very determined and purposeful investor class. The other day, hopefully you are in the media, so I'm hoping you read that Abraj acquired Java from ECP. Now, just take a step back. Java is a coffee house chain. ECP is a private equity firm out of the US. Abraj is a private equity firm out of the Middle East. Did you know that ECP owned Abraj? Leave alone, owned Java. Leave alone that they have sold Java to Abraj. Did you know Helios owned Telkom Kenya, which is rapidly emerging as our number 2 telecom operator? Did you know Helios owned Shell? Why are these people here? These are large investments. These people are here because of those mega trends that Kip outlined: the youth, the economic growth, the sectors. They are here for those reasons. And my plea to Kenyans who will be educated by you people in the media is to take a greater interest in what is happening in terms of investor flows. Because otherwise, you will wake up one day and you will wonder what happened? Why were we asleep when a new economy was created and it passed us by? Thank you.